Have you ever wondered why some investors become billionaires while others lose everything? The answer doesn't lie solely in the wins. It lies in the mistakes they've learned to avoid. Today, we're going to dive into some of the most serious blunders made by legends of the financial world, so you don't have to learn the hard way. Warren Buffett, the oracle who also made mistakes. Warren Buffett is often described as the greatest investor of all time. With a net worth exceeding $120 billion, he transformed Berkshire Hathaway into a financial empire. But here's what most people don't know: he made costly mistakes, some worth billions. Mistake number 1. Dexter Shoes, 1993. Buffett bought Dexter Shoes for $433 million using Berkshire stock. At first glance, it looked like a solid investment, a shoe company with a competitive moat. But soon after, Chinese competition eroded Dexter's market share. The investment ended up costing Berkshire over $3.5 billion, considering the lost value of the shares used for the deal. Buffett later admitted, "It was probably the worst deal I ever made." Lesson: even companies with apparent advantages can lose ground. Overpaying for a mediocre business is fatal. Mistake number 2. ConocoPhillips, 2008. Buffett invested heavily in the oil company expecting prices to remain high. Then the financial crisis hit, oil crashed, and Buffett lost over $2 billion. You have to be emotionally detached. The market doesn't care what you want to happen. Mistake number 3. Sunk cost fallacy. Buffett has admitted to holding onto bad stocks for too long just to avoid realizing losses. The first rule of investing is, don't lose money. The second is, don't forget the first. Mistake number 4. Missing Google. In the early 2000s, Google's founders Larry Page and Sergey Brin personally explained their business model to Buffett. But since he didn't fully grasp the technology, he passed. Google went from pennies to over $3,000 per share. Lesson: know your circle of competence, but also be willing to expand it. Peter Lynch. The myths that lead to ruin. Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990, delivering an astonishing 29.2% average annual return. But his real legacy? Busting dangerous investment myths. Myth number 1. It's fallen so much, it can't fall more. Lynch reminds us of Polaroid, a beloved company that eventually went bankrupt. Just because a stock is cheap doesn't mean it has bottomed out. Myth number 2. It'll come back eventually. Think of Blockbuster. At its peak, it had over 9,000 stores and dominated home video. But it ignored disruption, Netflix, and vanished. Just because something fell doesn't mean it's cheap. Just because it rose doesn't mean it's expensive. Benjamin Graham. Even the father of value investing struggled. Benjamin Graham, author of The Intelligent Investor, taught Buffett himself. But he wasn't immune to mistakes. In 1929, during the infamous stock market crash, Graham used leverage to increase exposure, thinking the market had hit bottom. He lost more than 50% of his personal wealth. Lesson: leverage is like driving fast on a slippery road. It magnifies every mistake when markets turn. George Soros, the billionaire who wins by admitting he's wrong. Soros is globally known for breaking the Bank of England in 1992, making $1 billion in one-day betting against the British pound. But his real superpower? I'm rich because I know when I'm wrong. Soros believes markets are driven by perceptions and emotions, not just fundamentals. His theory of reflexivity explains how bubbles form. Prices move based on collective belief, not intrinsic value. Lesson: recognizing a mistake early is more valuable than being right and holding on to a bad idea too long. Ray Dalio, the price of blind conviction. Founder of Bridgewater Associates, the world's largest hedge fund, Dalio learned the hard way. In the 1980s, he predicted an economic depression in the US, and bet everything on it. But the economy recovered. Dalio lost everything, had to lay off his entire team, and even borrowed from his father to pay bills. Instead of giving up, he came back stronger, creating the famous all-weather portfolio, built on real diversification. If you're not prepared to be wrong, you're not prepared to invest. Charlie Munger, the master of financial psychology, Buffett's right-hand man for over 50 years, Charlie Munger believes psychology trumps math in investing. He identified over 20 cognitive biases that sabotage investors. Confirmation bias, seeking only what confirms your beliefs. Endowment effect, overvaluing what you already own. Social proof, following the herd without thinking. Lesson: successful investing requires independent thinking and the courage to act against the crowd. Cathie Wood, innovation, optimism, and volatility. The founder of ARK Invest, Cathie Wood made bold bets on innovation, AI, biotech, and robotics. In 2020, her ARKK ETF soared over 150% during the pandemic, only to crash more than 70% in 2022. Why? Overly optimistic projections, rising interest rates, and high volatility in growth tech. She also relied heavily on Wright's law, which predicts tech costs drop as production scales, but many critics argue this isn't universally reliable. Lesson: innovation is exciting, but risky. Blind faith in macro trends can expose you to serious drawdowns. Luiz Barsi, quiet discipline that builds fortune. Luiz Barsi is Brazil's largest individual investor. Born to poor immigrant parents, he built a fortune by buying dividend-paying stocks. His biggest advice? People focus too much on stock prices, but it's dividends that pay your bills, not the quote on the screen. He preaches a simple, yet rare philosophy: keep buying, even in bear markets. Reinvest dividends, always. Lesson: building wealth doesn't require genius, just patience, discipline, and consistency. Conclusion: what do all these geniuses have in common? Despite their different styles, all these legendary investors share core principles and common mistakes. Frequent mistakes: acting on emotion, ignoring fundamentals, overconfidence, lack of diversification, arrogance toward the market. Practical recommendations for you. 1. Do your homework before investing. 2. Acknowledge mistakes quickly and adjust. 3. Stick to a disciplined strategy. 4. Invest with a long-term mindset. 5. Don't follow the herd, stay rational. If you've made it this far, congratulations. You're doing what most don't: learning, preparing, and becoming a smarter investor. Now share this video with that friend or family member who thinks investing is just about guessing the hot stock. Subscribe to the channel and hit the bell icon, because in the next videos, we'll show you how to build an anti-fragile portfolio, how to spot market traps, and how to protect your assets even in the worst scenarios. Remember, you don't need to be perfect. You just need to learn from those who already made the mistakes for you. See you in the next video.